do is I'm actually going to start the recording. So this session is being recorded. You'll get a copy of Susie's deck. My name is Kevin North. I'm a mentor here with the SCORE Twin Cities chapter. And just a quick slide on what SCORE is. SCORE is a national network of over 11,000 volunteers. There's hundreds of SCORE chapters across the U.S. The SCORE Twin Cities has about 130 mentors, such as myself. We're underwritten by the Small Business Administration. And really the mission is mentoring, which is free. I'll emphasize free to small business startups. And part of our mission is also to provide workshops such as we're doing today with Susie. And my one ask of you today is that if you do not yet have a mentor, I highly encourage you to consider going to twincitiescore.org website, and it's very easy to request a mentor. And I'll also put that link into the chat. And so with that, I am going to actually stop sharing my screen, allow Susie to bring her deck up. And again, welcome to those who are joining. And again, this session is being recorded and you'll get a copy of Susie's deck. So with that, take it away, Susie.
Okay, thank you so much, Keith, for that. As I was reading the chats coming in, I'm like, oh, how does that company work? And it's just fun to see what people do to make money and finding the new creative. I never thought that that would be a job or a business. So some really fun and creative companies out there. So congratulations on that. And a lot of, I always say Minnesota has the most creative names and services out there. So let's get started and go ahead. I am a ask your questions as we go type person. Since this is my first time, I'm doing a broad overview on different financial reports to help you run your business. So if we don't get all the way through, we can do a follow-up to this. If we find we need more detail on certain reports, then we can set up a workshop to go through those reports then also. So as I talked to Keith going, what should we talk about? You already have how to set up and run QuickBooks Online and QuickBooks Desktop. And I'm like, being able to read the reports and know how to use them in your business is very, very important to your business. So, and go ahead and connect with each other. If you see a industry or somebody you want to network with in the chats, yes, do that. That's why we have these things, is for that connection. So how to use financial reports in running your business. Again, my name is Susie Jose. I am the owner and founder of Carefree Bookkeeping here in Minnetonka, Minnesota. And here's my contact information. I am QuickBooks certified and do use a couple other softwares on top of that. And there's my website, and you can, it's on the end of the page too, for any contact information. So here we go. The most popular financial reports are the profit and loss and the balance sheet. Some people call this the P&L, some just call it financial statement, but this is what they're talking about. All good accounting softwares would, oh, hang on, I got Keith calling in, so hang on a second. Hello? Yep. No? Okay, I am still on. Can anybody please put in chat to make sure they can hear me yet? Yeah, okay, they can still hear me, so we're good there. Yep, so we just lost you. Okay, yep, fine. Hey, technology with road construction going on. Thank you very much for that, everybody. So we just lost Keith, but he'll pop back in. Okay, so another thing with profit and loss statements and balance sheet, it's also your history report. Accounting bookkeeping is always saying what has happened in your business. So we look at this for trends and what's going on and trying to get that. I'm not sure what's going on. So right here, we are having January through December of 22. Now, this time of the year especially, I want to grab January through September and then compare that to last year, same time frame, to see how our sales is year over year or month over month. And then go ahead and hang on. I have two other presenters in here that I'm going to add in. And hopefully I'm doing this right. Oh, you can't see the side deck. Okay, thank you very much. So let's try this again. Share. All right. Now can you see the slide deck? Okay, beautiful. All right. So here's the P&L. So couple things with this time of the year. We want to look for tax planning, which we'll cover a little bit at the tail end. But most importantly, how are we doing in our business? And what are our trends? Because I know we have some restaurants and manufacturers that don't have a consistent day in and day out thing happening. So you want to follow those trends. Manufacturers, there could be coming in really into their busy season right now, getting everything shipped out for Christmas. Or if they have summer festivities that are going on that they need to send stuff out for. Restaurants, we know restaurants are slower in January. So we would pull up last year, January, to help predict what do we need to buy for food and those kind of things. So we're using our history and learning from our history to be able to predict the future. So that's why we review and look at our stuff and see what's going on. The balance sheet is what the banks are most interested in. And if you were to go and sell your business, that is what your brokers are going to look at. So just to go through this quick, we have our income here, our cost of goods, which is anything that it costs you to sell your product or your services. So with a marketing firm, it could be those specialty softwares you need to produce the marketing.
Okay, I've got it. Thanks, Steph.
Restaurants. Okay,
Yeah,
great.
bye.
Welcome back. For restaurants, that's going to be your food. For retail store, that's going to be the product you're selling. So all of that stuff comes up here. We could, for shop supplies, we would put in the bags and containers that go out with the product you sold. Then you just have your regular general administrative cost down here that are standard for any business. So it doesn't matter what industry you're in, these would be the same across the board. On the balance sheet, we have your checking, the money you have, accounts receivable, who owes you money, what's undeposited funds or on the way to the bank with direct deposit and mobile deposits, that's not such a big thing to lose something, but I like to call this, it's in the truck phase of making that deposit. So this is, you receive the money, but it's not deposited into the bank account yet. That's where that money sits. You have your fixed assets and depreciation. And then there are liabilities, who you owe money to. So that would be your credit cards, the lovely state of Minnesota, any loan you would have, be it vehicle, equipment loan, loan paying you back for investing money in the business. And then down here we have our equity, meaning this is what you took out of the business to pay yourself. And then your retained earnings, that is the combination of the prior years of net income. So we'll be flipping back and forth a little bit and referring to this report and a couple of other pages here. So the most common mistakes on the financial statement when you're entering in stuff, and why I get called, is the credit card. Your credit card lives on your balance sheet, and because that is, you owe the credit card that money yet. The expenses that you charge on your credit card, those go onto the profit and loss statement as expenses. So every transaction in accounting has two sides. So that's how that runs. So then when you're making your payment to your credit card, that's going to go from, and that's going to be just on your balance sheet here, is going to come out of your checking account and get applied to your credit card down here. And that payment won't be hitting again, so we don't want to get double entered there. So if there is interest for that credit card, that also gets just put on the balance sheet or on the P&L as interest paid, because your interest is a tax deduction. So we want to record it over here. Your main part of your taxes is all taken from your profit and loss statement. So for those that have taxes, sales taxes and tips, I know we have some restaurants here. We have some clinics, they would have provider tax here. Those are entered on the balance sheet. And there's a couple different ways of recording that. When it's coming over the credit card statement or your PSO system for the restaurants, that taxes and tips are going to be in the sales number right here. So then what I like to do is create a negative account called sales tax and a negative account called tips. Now that offset for those entries, and I know you guys are going to go, oh my word, this is so confusing. But again, this is just the overlay of things, and we can dig deeper for the specialized things. So it's going to come in as a negative to your income. So now you have your true company income here that does not include money you've collected that needs to go to your employees or the state of Minnesota. And with the mental health and then the clinic, yes, you're going to have provider tax that is due to the state of Minnesota. So instead of sales tax, you have provider tax for professional things. Are we still not seeing? Okay, I think we got that done. All right. And then, so that's, again, just going to, once we have that entry hit down into here that's due, Again, when we pay that, it's just going to come out of checking and offset what's due down here to the state or your employees. And then the same thing with loans via business loans or car loans. The interest is going to go on interest paid, and the payment is going to go from the checking to that loan for that principal amount, because we're going to be reconciling your loans every month, every quarter, to make sure that that's done properly and matches with that third party. Okay, so I don't see any questions so far. All right, here we go. So we're gonna look at Craig's landscaping. Okay, Kathy, you have a question. You want to pop that in the Q&A section, because then I can see it easier there, and be able to answer those as we go. That would be wonderful. So do we know we're making money? Oh, can I explain the loan thing again? Okay, most definitely. So when you get a loan, let's say this is your first time getting a loan, that money is getting deposited into your checking account. And let's just use easy numbers. Let's say it's a $5,000 loan. So that money is going to come into the checking, and you're going to add $5,000 right here. Now the offset to that is going to be loan payable. That is your principal amount of the loan that needs to get paid. So that 5,000 is going to come down and sit down here under loan at that $5,000 mark. Now, nobody loans you money for free. So you're going to have interest for that every single month that you're going to pay on your base monthly fee. So let's just say it's 10%, because that's what the interest rate is right now. And 10% of a $5,000 loan is $50 of interest. And let's say your loan payment is $200. So when you go to write that check or transfer that money, it's going to be a split entry as an outgoing payment, check, expense, however you're using it in your QuickBooks. And we're going to have $50 go to interest. That's going to sit over here on the balance sheet, or on the P&L statement, sorry. You guys going to have to help me remember which ones are which. That's really a test. And our $200 payment, 50 of its interest, that gives us $150. That $150 is then going to come over and reduce the loan amount by $150. So now your new loan amount is that $5,000 less the $150 for your principal balance. And then the bank gives you a statement every month or every other month of, here's what your new principal balance is, and that needs to tie out to here. Right now, I just got a client signed in yesterday because his banker, hey, the loan amount still says the same loan amount that it did a year ago. We know that's not right because they've made 12 payments in the last year. So they're having all of that come over here on the P&L. So I got to pull it out and put it and adjust it over here. So yes, you would submit the monthly statements to the bookkeeper so that they keep on top of that. They absolutely have to do it for the end of the year before you file taxes. But when you can do keep the monthly stuff all nice and clean, that is the best for everybody around, because now we have true information to look at what's happening in our business. So you want this stuff to tie out every single month. And yes, QuickBooks has the bank feed come in and you think it's reconciled, but you always still have to reconcile each of those bank accounts every single month. Because stuff gets tied up in there, double entered, and all sorts of fun things. Okay, so how do we tell if we're losing money? So construction is a great example of cost of goods. Restaurants, when you're putting your food in here and your supplies, manufacturers, and also a really good one that has lots of cost of goods sold type thing. Same with retail stores. So those are all good examples of things. So yes, we have our income that came in. And then again, we want to look at a bigger time slot when you're going throughout the year, because when you buy the food, the product we're selling, we're not selling that immediately in that same month. So we look at it as the whole year. And then if something doesn't look quite right, yes, we also want to look at it as each month going on to help you with your trends. But what we want to do is capture that in different industries. It's different. In a 30-day time frame, in a 60-day time frame, what does this look like? What are our sales? What are our expenses? And then what is our gross profit? This gross profit number is your ticket to know what's going on. Whoops, didn't mean to click. In your business. Are you making money doing what you do? This person is making $4,000 in the first 5 months. Their gross profit is 41%. For a landscaping company, 41% is beautiful. Now, retail store, probably want to see this more closer to a 50%. For let's say a gas station, is going to be around 20%. So it depends on your industry and what this percentage is supposed to be. Now, quite simple math to come up with a percentage. You take your gross profit amount and divide it by your income amount. That gives you your percentage. So this tells me here we got subcontractor in there, but that's not us doing the work either. So let's say we add another $1,000 in here for your labor that you did actually planting the plants and soil. Are we still at a good spot? Because you need to get paid as the business owner also. So we need to make sure that we're in industry standard area on this. And let's say this is actually 20% for this landscaping person. I'm going to get excited and go, what's going on here? Are we spending too much buying the materials? Can we buy the materials cheaper? Are we not charging enough? Is this add-on service of pest control worth our time? Because the landscaping service, we can bang out and get that done. Do we have to hire the designer? Or can we do that ourselves? Or are we spending too much time on designing? This is where we do all of our Q&A on the business to know what's going on. And are we charging enough? Are we spending too much down here? Are we missing part of, or doing an add-on? We call it the creep sometimes, or change orders in construction. are you providing additional services that you're paying for that the customers are now not paying for? Are you, do you need to adjust those prices? So this is where we start our investigation of what's going on in your business. And again, every industry is different right here. So that is where that is. So other quick things is, especially if you're trying to get a loan or a lease on a building, they always ask, what is your break even? And I know going through the SCORE program, you go through this a little bit, but what does that break even point mean? So here we have that gross profit. So we have $9,795 left to spend on our monthly bills after the sales less the cost of goods. So here are our standard bills that any company has, or administrative cost is what I call this. So every single month I need to have, and then whatever this other is down here, Intuit has started putting other expenses like the vehicle down here. So then you got to capture this number plus this number. So we are talking about $8,000 every single month that we need to pay all of our bills. So 8,000 off of that gross profit is our break even point. So now we have just under $2,000 as profit. Now this profit number is your taxable number. Now that does not mean that's the cash in the bank, because when we pay the loan payments, credit card payments, those kind of payments and sales tax are just making out of your checkbook and into that liability account on the balance sheet. So those don't hit, those are hitting your cash, but they're not hitting your net income, because that's not how it works. But that's why your P&L statement is for history and taxes, and your cash flow is different. And we'll get into cash flow in a little bit. But when you're going, oh my word, what do I need to do in sales every month? When you're looking at, you're like, I need to make sure that I have $8,000 coming in every month just to pay my monthly bills. That's not including paying for the cost of goods to be able to charge for what your service is. Nonprofits, when you come up with what do you need to raise every month, this is what it would be, is what are your flat income amounts going to be that you have to keep the company going. Okay, so briefly explain the 8,000 amount again. I have 5,000 right here of expenses that, whoops, keep clicking. That is your regular total expenses. Plus I added in this other expenses down here of almost 3,000. So 5,000 and 3,000 is the $8,000 here of monthly expenses you would have. And with QuickBooks, this is probably your vehicle costs, travel costs, those kind of things. I personally like to have it up here. Up here, I do have that automobile up here, but this set of books for some reason has other expenses. So you want to make sure you're grabbing both totals and capturing all of your expenses there. Okay, wonderful. Okay, so we're going to keep moving on and look at the cash flow. So this is looking at your checking. This is a view of what's happening in your checkbook. Okay, you have more money on some days and less money on other days, but you're collecting money in and out, and you're always spending money. So when we look at cash flow reports, we never want to go more than 90 days because that's too far out to predict, and there's too many changes that are happening. Sometimes it's, yeah, we'll have that 90-day look, especially with manufacturing. You really do. Manufacturing is the one where you would look further out because you're planning for your high production months, which is going to be a lot of cash out. And those kind of things. But everybody else would keep it at that 90-day mark, and more focused on the next 4 weeks. And this is a running report. So after week 13, we'd go to 14 and just keep extending it and shrink up these other ones. So the first part of a cash flow report is your income report. So let's say you have $30,000 sitting on your accounts receivable report right now. That's the people that owe you money right this minute. Of that 30,000, when do you think you'll collect that money? Okay, so we put 5,000 a month or 5,000 a week is our goal for collecting that, and we think that is reasonable for that. Now, if you look here, I have 30, I'm only collecting 15. Okay, that's kind of realistic, but that's not what we like because we provided services, so we want to keep on top of that. That's a whole nother conversation. I did this as a professional services, so there is regular monthly clients coming in, and out of your regular monthly billing, what's going to come in and when. So I put in that there's a little bit coming each month or each week. And it might be 11,000 comes in here, and then I don't get another 5,000 until here. So it's knowing your clientele, or here's in the restaurant where you would put in what weeks do you have more money coming in, and what's based on your history, where you pull that profit and loss statement by week, where you can predict what's coming in for that week. And then for special projects, say you do something that's not normal, like that pest control thing that's not normal for a landscaper, you would put that in here is when you're going to build that out or collect that money. And then how do you deal with increase of owner equity on cash flow? That I would, in owner's equity, meaning the owner's equity is the amount that you own of the business on paper, or are you talking about wanting to pay the owner more? I need a little more of an explanation there of what you're looking at there. And then another part.
Susie,
Yep.
Maybe just a quick question. Maybe the question is, as the owner is estimating their cash and they're going to infuse more cash into the business, how is that?
Okay.
How is that incorporated on your?
Yep. We'll hit that at the end of this report. Okay. Thank you for that clarification. Okay. So what's going out? What are you expecting to go out? So you're going to have your payroll, and you kind of know what your payroll is going to run and when that's going to run. Your cost of goods, what you're going to need to sell your product or your food or your sellable items, that goes there. Here is what you expect to pay yourself. And there's a couple different ways we'd figure that out. It depends on what your industry's doing, how much you're making, and that fun jazz. Are you going to pay your future self? And that is the best tax deduction that you can have, meaning you pay your future self instead of Uncle Sam to reduce your taxes. And you're also saving for your income taxes to pay on April 15th or March 15th, depending on what your entity is for your business. We always want to be saving for that along the road, along the way. Yes, another name is owner draw, owner pay. We figure that out into here, right here of what we would like to be taking. Now, if we don't have the money, sometimes we don't get this. This is what the perfect world would be. I mean, yes, I would like to get $1,000 every week, but that doesn't always happen. And then here again is your administrative fees that you have every month that comes out of your checking account. And you look at your checking account, what's come out, and that also and match that to your P&L statement, because some of it's on the credit card and you're not going to pay for it yet. So then you could do just what's coming out of your checkbook and then put down what are you going to pay. Are you paying the minimum balance on your credit card? Because your credit card fees, oh, there I go again. Your credit card fees or the balance you're going to be paying your credit card would be going on here. If you pay off the whole amount every month, what does that average out? And you don't have to have it broke out by week like this, or you could, if you're tight on cash flow, you don't have to wait for the due date to make a payment to your credit card. So if you're like, I have more money here, I want to make sure I'm meeting that minimum amount or making a payment to get ahead, go ahead and do it when you have the money. It still gets applied to the amount they want for a minimum, although some will still take a minimum amount out, say $35, $40 for that week, but it also reduces your interest that you're being charged. Because credit cards, if you have a running balance, charge interest on everything the day of your charge. So they don't wait. It shows up on the statement a month of here's the interest for the month. But every single product that you're adding to that, interest is accruing right away. But then here you also put a lot of people got the EDIL or their business loan. You make sure you put those payments in here because this is cash flow, cash coming in and out of your business. So then it comes over, everything flows over here, the total amount collected and the total amount expenses that you are estimating to go out that week, because this is the projected. And then I come off of those other two reports. Then you put your checking account beginning balance in here, and then that's going to give you your ending balance. Now, after week one, we're like going, oh, we're good on week one, we're good on week two, but now what happens if you didn't collect this $10,000 on week one? After week one, we come in and adjust this to actual. And then we change this to actually what came in that month. And this to actual. And then this changes to actual, this gets us to what is currently in our bank account and it flows over. Because when we do this, we can see week 10, we're predicting that to have enough money. Well, as you can see on week 10, we need to buy a lot of product or have a lot of cash going out to keep the flow going. So here, where are we going to make adjustments? Are we going to really try hard to collect all of this money in here to make sure that we have cash for here, to try to collect some of that old 15,000 that's still sitting on accounts receivable? Or do we have to reduce some of this outgoing money, meaning your pay, or we don't buy it much? And this is where we start really playing. Do you really need to buy this product to have on the shelf because I sold 2 and now there's only 3 left on the shelf? But how long was those 2 sitting on the shelf before they got sold? So do we strategically place our orders for what's going to be first in, first out of our shelves that's going to make us money? Or do we need to make sure, because if we know this is coming up and we need to either know that we're going to infuse our cash out of our personal account into the business to help that, or are we going to go get a business loan? I'd rather get a business loan here and get it all the way set up when we don't need it than to try to get a business loan here when we absolutely need it, because banks are tightening their belts right now. It's getting harder to get money loaned to us. Got to make sure that we do that when our books are good, our cash flow is good, which we'll hit. Now I'm getting ahead of myself again. So that's the important thing about doing a cash flow plan when you're tight on your money. And maybe this is the cash flow that's coming on, but here we have money put aside from the previous 12 weeks that we put in the savings. So now we're just going to grab it from the savings account to cash flow ourselves. So that's where we kind of always want to keep on top of it when the economy is going bad and when the economy is going good, because when it's, oh, I have lots of money in the account, let's go ahead and make this. You still want to review your trends in your industry and go, no, wait a minute, I need to make sure that in the fall, when I have to make this big purchase for the product or our annual fees, I have that cash. So I want to make sure I'm putting money in the savings account. And you can go ahead and put right here, transfer to savings, and put whatever dollar amount is so that you're planning and you're self-funding that, and then just automatically make that move over there. I think every business should have a savings account for saving for future growth, future purchases you have to make, and your income taxes you have to make. All of that money should be going into the savings account out of sight of your checking account. Okay, so where do we find that cash? And I just kind of went through that a little bit. We're going to find cash on your accounts receivable report, the people that owe you. You're going to find cash. That's where we look. Are we charging enough for our stuff? Do we need to raise our rates or raise the sell of our product? Are we not getting everything collected? Keeping on top of that. Go ahead. Send out statements 3 times a month. Guess what? You're going to, it's going to aggravate your clients and they're going to pay you. Demand that you get, if you have a service industry, demand that my invoices go out and I am paid within 24 hours. You can do those kind of things because you have payroll and expenses you need to pay. This is where your worthiness really comes in, especially women have a hard time demanding that they get paid for their services they provide. That's where we want to keep on top of that. And if we need to adjust our expenses of some sorts, we can do that. So money is usually not found growing on corn stock where we could just collect it. COVID was a rare occasion. And I had my clients pivoting and creating new sales revenue during that time. And so maybe that is something, is part of your business not making the revenue. It should be in certain areas that you need to pivot a little bit and concentrate and creating a new sales out there for that. I had a business coach that I'm like, well, why don't you charge for accountability services? I never thought of that. So that is something that's in the wheelhouse of what they do. And if you were a actual client of that business coach, that would be part of what they're doing. But what if you don't need the business coach, but you just need somebody to hold you accountable for getting your tasks done that move your business? You know what's going to move your business forward, but you need somebody to sit down and make sure you're working on your business instead of in your business, because that's how you grow. Those are different ways to find cash in other different ways. And here again, here's the accounts payable. Everybody in the 31 plus day column, they should be paid. They, even making phone calls back in the day before all the email stuff came up, and people paying online for everything, we were making phone calls. Where's the money? Where's the check? Please show me a picture of you mailing the check. And then, see if you can get some of these people to pay faster, or send out, hey, just wondering if this invoice got lost in your email. I'd like to make sure you got payment for it. You collect more money being nice and respectful to people than you do with, hey, my bill is late, I need to get paid. When I did W-2 job collecting money and calling and asking people for this money, they're like, hey, we have your check ready, you want to come pick it up? You're always my first phone call because you're not jumping and yelling at me every time you call. You're just nice and sweet, just saying, hey, were you able to get this done yet? Now that is business to business, because normally that person in the accounting function that you're calling is not the one signing the check. So you always want to be nice to those people that have nothing to do with signing the check. Can the reports be quantified by a bookkeeper to help business owners? Most definitely. They can help you analyze this, put these reports together for you. This is stuff that my company helps support our clients with. They can do different insights. So this is kind of an add-on service we do with our clients, because this is what in the old days CPAs used to do, or an accounting function used to do. But now bookkeepers are starting to do more and more of this kind of work because there is such a lack of it. We're in depth, we understand how to read the reports. So we can help you and give you warnings on that. Now, business owners should still be on top of some of this stuff and understanding this, because it is your money, your business. So don't 100% rely on your bookkeeping firm to do this. But you can ask, hey, can you send these reports to me every single month? Can we sit down and go over these reports? Can we do it once a quarter? That most definitely can get done. And if your accountant or your bookkeeper is like, I just know how to do this certain spot, because in bookkeeping school, we're only taught to push the reports out and not to interpret them. When you have more experience and more education, that's where you're taught on how to interpret these things. So it just, but ask your people if this is something that can be done. Okay, so paying yourself. Yes, you're the boss. You're not guaranteed to make a paycheck. Your employees get paid before you do. This is too where we start really looking at the reports going, are we running a business or is this a hobby? Okay, because if you're not paying yourself and you're losing money, then it becomes a hobby. You would make more money going and getting a W-2 job at Target versus running this business. Now, not to say as you get started in your business and are growing your business that you make this judgment on it. Some industries take 3 to 5 years to turn a profit. And you know what? If you're paying yourself, you're cash flowing everything, your business can afford, you're happy, and your profit and loss statement, net income comes to $10 every single year. Beautiful. Love it. I'm okay with that. That means we don't have to pay so much in taxes. But these are things to look at. You know, maybe it is you can't have so much support staff and you need to do some more of your stuff or raise your rates so that you can afford to grow your business and save up before you get to that thing. And looking at your cash flow report, do we have to adjust? And giving yourself bonuses every quarter. Yeah, we can always give you more money. It's harder to take money back from you, from your personal account into your business account, because you have that earmarked for vacation or for the kids to do something or Christmas presents or whatever. And to say no, now that that's already out there, it's harder. So always be watching that and your cash coming in and out. So, okay, it's 11:55, so I think we got a couple more slides quickly to go through. So your taxable income. So when we look at the gross profit of your business, your gross profit is your income less your cost of goods sold. And we take all of your expenses out and you come down to this net income amount. That is your taxable income. When I do a quick, fast, and dirty, what do we need to be worried about for taxes? And this is when I start looking and worrying about that right now. So especially if we're short on cash, we can save the money up to make your estimated tax payments, because you kind of really want to make those by January 15th, because that's the 4th estimated tax payment for the year. We do it off of this number, and we go in here if there's something, if you're paying your health insurance, your personal stuff through the company, we add that back into this amount. And then what is your tax bracket? Are you in the 12% tax bracket? Then we take 12% of this number. If you're an LLC, we need to add 15% for your self-employment tax above that 12%. And then we also need to add the state of Minnesota, their lovely 6% income tax. So that's where, remember, this is not your cash that's in your bank. This is your taxable income. So this is what the money that's come in and out of your business for between January 1st and December 31st. So, and then leaving the money in the business for taxes, tips, income tax, go ahead and move all of that to the savings account so you're not spending it on a monthly basis. Sometimes taxes are quarterly payments. Provider tax is a quarterly payment. When they're short on cash flow, I go ahead and make those as monthly payments. Your sales tax, if you only have to pay sales tax on an annual basis, you can make estimated payments to that. State of Minnesota loves early payments, but that just helps your cash flow better. Or because we're actually starting to make interest on our savings account at about 5%, we can collect that 5% interest on that and then pay it when it's due on that estimated date. When should you hire somebody else to help you in the business? Okay, so when you're leaving money in the business, and that kind of, not really, if it's in there, if you're a big company that runs on cash and you're making $3 million, that's where you most definitely need to be talking to your CPA about that. That's a little above my pay grade on how that works. However, most of us file that are small business on a cash basis. So that means the money has come in here and it's gone out here. So here's our taxable income. Okay. Now, this isn't all the money that we've spent, because maybe some of this is on the credit card or on our accounts payable, except for cash, it wouldn't be that way. But if we have an LLC, the balance sheet does not hit the tax return. You're paying taxes solely on the profit and loss statement. So then, no, leaving the money in the business, you're not going to get charged additional taxes. On an S Corp, you're going to put, the balance sheet also shows up on the tax return on an S Corp. These two reports are your tax report to the IRS as an S Corp that gives you your K1. So you're being taxed on, you know, having all of this figured in, and it's such a complicated formula because, you know, that's how our politicians like it. But that money is still sitting in there. So no, you don't get taxed twice on the same dollar. So I know that is something some people worry about. Oh, I gotta make sure what they're doing. Those people that have the big amounts of cash that run their checking account all the way down to zero at the end of the year is they're filing on cash. They need this to be as big as possible. You know, that's where you're going to prepay your utilities, prepay your rent. Well, now you're going to be prepaying all of that every single year because you still need 12 months in here. So that's where you start setting up retirement accounts to pay your future self and come into all sorts of other little fun tax strategy ways to do that. So keeping the money in the business is fine. That makes your banker very, very happy to do it that way. So, because they know that you can afford to get the loans then because you have the money to pay it. You always want to get your loans when you can self-fund yourself. Because that liability that the bank will have that you are foreclosing on your loan is at such a low amount of money. So that's why I want to make sure we talk about, can we get loans now? Yes, get loans before you need them. So when you do that, oh my word, is it time to hire somebody for helping me with the social media or the marketing? Is there time to hire a bookkeeper? Michael Gerbert with the E-Myth books, which is a brilliant book model that sets it up nice and easy for any industry out there. And then there's some industry specific books on top of that. Is hiring a bookkeeper to do this bookkeeping work is your first hire. I'm not saying this to have you guys hire me. That's not what I'm out here to do. My goal is to educate people so that they can become successful. There are lots of firms out there. It's finding the right mix and personality for you. But how long are you spending on doing your books and getting you're spending so much time balancing your books and making sure the bills are paid that you're not getting the invoicing out? Is it, I don't know what to do now, I can't go on sales call or networking calls so that I can bring more clients in? When you doing the work is hindering you growing and getting more work and building your business, then it's a sure sign you need help. So what you do is you figure out, how much is this going to cost me? Okay, you got that price down. Now, if I get one more client or two more clients, or am I able to bill this client, because you're billing by the hour, which I don't recommend. If I do 2 or 3 more hours of work, then is that going to pay for that? And guess what? A professional bookkeeper and a professional marketing person, this is what they do every day. This is what they train to do. This is their passion. They can do that stuff in half the time or less than you can. So it's not, oh my word, I spend 10 hours a week doing this. It's, they're going to spend 3 hours a week doing this. I have a client, they were spending 20 hours a week trying to move their money around and figure everything out and get it all entered in. And they did not have invoicing to do because they got automatically paid on commission. I walked in and I now do the books for about 6 hours a month instead of 20 hours a week, because we have systems to get this done and know how to do this faster. So same with the house never gets clean. If you bring on one more client and hire a cleaner to come in and clean your house, go ahead and do that. So this is how you grow your business, is you focus on your business. And if it can be done by somebody else and you can afford to hire them, you do that. Kids can shred, kids can file, kids can learn to clean their room and do the dishes. So you don't have to do it all. I like to say my superhero cape is at the cleaners and I don't have it right now. So I need somebody else to help do that. Oh, hey, and we're back to tax planning. And here we go. When you have this as your bottom line, that 115 mark, and or we're predicting it to be at the end of December. This is where you want to talk to your CPA. Most definitely, we need to change. Our first thing would probably be changing your LLC status to an S Corp status. But I also want to look at, is this a fluke? Is this the new trend? Where are we going with your business? Are we going to bring on a whole bunch of other expenses that will drop this number down next year? So this is where we really want to start strategizing on what you're doing with your taxes. Because as an LLC, this $115,000 would be taxed at 15.3% just for your Social Security and Medicare, because you're paying the company portion and your portion of that. So say that this is here and, oh, let's get this company switched over to an S Corp. Let's give you a $50,000 salary for the year. Now, half of that 15.3% is a deduction for the business. And the other half of that 15.3% is paid out of your paycheck again. Most of us have had a W-2. So now we're not paying that whole percentage on this 150,000. We're only paying it on 50,000, 115 versus, 50. So that saves a lot of taxes right there. It does cost more because it's an actual additional tax return. And then too, your SEP, every single one of you right now can set up a SEP plan. You do not need to have payroll to do that. You can put around, and don't quote me, but you can put around $23,000 per year into your SEP plan that is going to essentially be coming off of this 115 because you're paying taxes in the future. Okay, so you're putting the money in an investment account and pushing that tax bill further down the road. So if we're not set you up as an S Corp, because next year is going to be, this is a fluke, then that's what we want to do. Let's totally max out your SEP plan. And you don't have to put $23,000 away every single year on the SEP plan. If it just turns out to be $2,000 the next year, then that's what it is. And you're never going to lose that. Do you need new equipment? Okay, and do you need? Everybody wants the newest, latest, greatest thing, but do you need new equipment? Then it's like, okay, yes, let's go ahead and purchase that. And that's why we want to look at your P&L statements starting now for tax planning, because we don't all have the cash sitting there ready to go. So if we're like, and to try to buy something new the last 2 weeks in December, to try to get an appointment with an retirement broker in December, not going to happen. And the SEP, we can set that up. We have until April 15th to set up that account. So we can say, hey, we want to get this set up. Here's $200, $300 to get it going and set up, and then fund that later until the day we actually file the tax return. So what some people do there is in April, they file an extension, making sure that the estimated tax proportion is paid in, so you don't get penalty and interest. With that, I'm planning to fund $15,000 into my SEP account formula in there. And when July, you have that $15,000 paid, then you file your tax return. And that's a way to strategically work with the cash that you'll have in your plan that you'll have. Do we want to save money to buy a building? I mean, there's all sorts of fun things for tax strategy. Just if you're S Corp or a partnership, your tax deadline is March 15th. If you're an LLC that files on a Schedule C, it is April 15th. So just know that businesses need to have that March 15th. With COVID, everybody got confused when the new tax deadline is. Everything's back to what it originally has been for the last, I don't know, 100 years. So, and estimated tax payments, if you only do $300 or $500 a month or a quarter, go ahead and put that in. IRS wants to see estimated tax payments. And yes, they want what it is, but you won't get the penalty if you make small payments every quarter on that. And then I have a SEP account set up now. However, last year my tax firm indicated that I did not have enough during the year to contribute the full amount to the SEP. Is there a special percentage of the net income you can pay? I pay what you can afford. So I personally put $250 every single month into my SEP. Okay, I did not start at $250. Go ahead, start at $50. Put $50 in every month. Guess what? You can add to that whenever you have more money. But when I'm used to that $50. Well, now the next year, can you raise it to 75 or can you raise it to 100? You keep building that up every month or every year as your business grows. You hit this new sales goals. Guess what? I'm going to celebrate by paying my future self an additional 10% of that sales. So it's not, oh my word, I got to fully fund it every year. It's what can you fund it with? It's still going to be a tax deduction. I'd rather have a $2,000 tax deduction than non-$200 tax deduction. So, you know, to max out a Roth, that's $433 a month. Can we all afford to do that? No. Okay. Roths are great. Roths will grow interest free. So that 400 you put in and you take it out 30 years from now, that's probably $4,000. And you don't pay taxes on that. So there comes in that, do we do Roth? Do we do SEP? Okay, I do a little bit of each. Now, my tax person says, why do you do Roth? You need the tax deductions now. I'm like, I still need that balance when I retire of non-taxable versus taxable. The other thing, Roth, you don't have to take out the money out of Roth. You can leave it in there and let that grow. Your 401k and your SEP, you're going to reach a minimum amount of money that you have to take out every single month to pay taxes on. So this is where you talk to, yes, your CPAs and your financial advisors. What is your personal plan? And moving forward. And doing something little, like $25 a month, you're not going to feel that. Because if I take out $100 a month out of your checking account, how is that going to impact your daily, monthly checkbook to your personal checkbook? Probably not about a lot. But if you put $100 a month in there, you're saving $70 of taxes. Okay, so now what is more important? So you just have to do with what works for you best. And okay, this page is, when should I open a line of credit? So SBA will guarantee 75% of your line of credit, which makes the banks very happy. That means they're not on the hook for 75% of your money. Oh yeah, I did earn amount. That's something that, yeah, you got to talk to your CPA. You have to have profit in your business to be contributing that too. That's stuff you got to talk to your CPA about. So when we have a good FICO score, when we are showing profits, when we show more in assets, meaning we have 23,000 in our checkbook versus 10,000 we owe. These all make the banks very, very, very happy. And they're like, yep, no problem. You'll have a line of credit set up within days, like within a week. Now, we all can't have the perfect world of this financial report. But if this is 50,000 and this is 2,000 and this is, 8,000, you know what? You might get a banker that goes, yep, I can see we can do it. Let's get it done. So having a good communication with your banker, you want the business banker. There are a lot of times there's a commercial loaning banker and an SBA banker. Get to know both of them. Good FICO score, they don't have to blink at, is 720 and above. If you got a fair FICO score, and you got books like this, they're probably going to push it through. It does not hurt to ask things of your banker. Your banker might go, hey, if you get this cleaned up or that cleaned up, then yes, I can push you through. Your banker will tell you that. So always ask, how does that look? Where can you go with that? Those type things. So is there any other questions out there that they didn't get? Any content that you want more of, let me know. This is how to reach me. The recording will be sent out to you. And I know I went over, but that's always how I go. So, all right. And Keith, Kate, can you explain why the balance sheet did not balance, or is there missing something? Well, that could be, yep, you're right, it doesn't. That's me taking real stuff and changing numbers, and didn't take the time to actually make sure that balanced out perfectly. Because these are just sample stuff. So these aren't real books. That's just that you get rushed and like, okay, I want this to go there and that to go there. So that's kind of what that is. So, all right. I think we're good.
Susie, thank you so much. Thanks everyone who did send a question into Susie, and thanks for providing your contact information. Just a reminder, you'll get a copy of Susie's deck along with a link to the recording if you want to go back and review it. And also, Susie will be conducting or offering a similar, if not the same, session in the future. We are going to talk about that, but this was a spot on, Susie. So thank you for modifying it. And thanks everyone for joining. And I did include in the chat a link to the SCORE Twin Cities website for those that do not yet have a SCORE mentor. There were a couple other questions about FICO scores, about form of organization, LLC versus S Corp, that SCORE offers help and assistance on. So look to those either through a mentor or through that website that I had mentioned. And with that, Susie, I'm going to give you the last word.
Oh, yeah, no, thank you everybody for showing up. This was a ton of fun. If you guys have any other ideas of what you would like to do, I'm always willing to create new content to put out there. So
Great. Thanks, everyone. Enjoy the rest of your day. Hope to see you at a future SCORE workshop.
All right. Bye.